Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back again, like it or not. Just kidding. Got with me in the studio today, Jeff Brooks. He is an accountant, CPA. He's got a ton of designations behind his name, actually. And he's with Apple Growth right here in Northeast Ohio. And I think you guys are just in Northeast Ohio. Are you beyond that, or?
Thanks, Bill. Appreciate you having me on. Yeah, we're right here in Northeast Ohio. We've got offices in Akron, Independence, and then we just acquired a firm in Beechwood. So very excited about that as of the first of the year.
Oh, nice. That's great. I spent a lot of time in that area, actually. I have to drive quite a bit. But anyway, I asked him here today because there are an awful lot of things happening in the tax area. That's a big deal. And there was a few years ago, I don't know if people really realize this or not, people are constantly coming and asking us for tax advice. And we're not allowed to give tax advice. It's part of our industry. If you don't have certain designations, your errors and omissions insurance won't cover that. So if you gave somebody some bad advice and they can come back and you could be liable and you end up having to pay out of your pocket. But so that's why I have people like you. And by the way, I use Apple Growth as my accounting firm for my firm. So Bullington Capital uses them. We're going to come back a little bit. I wanted to spend a couple seconds just talking about upcoming workshop. You had a couple questions this week. And in fact, I went out and I rebought the book, The Intelligent Investor. And unfortunately, I bought the updated version, which is nearly twice the size that's been added to and interpreted by another writer, which really is kind of upsetting when you spend the money on the book and then you get it and you realize that this guy's added 300 or 400 pages that wasn't there in the original copy. So I'm going to give that one away, I think, at the next seminar. And it's not that it's really bad, but it's kind of missing the point on several key issues, and it's getting lost in the chatter. A lot of unnecessary, unneeded pages. And if anybody knows me, they know how much I detest that. I try to keep things as simple as possible because life is complicated enough. We don't need to add to the confusion. We're going to try to keep as much of that out of it as humanly possible. Sometimes it's not all that easy to do. But anyway, that's what the next seminar is about. We're going to take a look at the Intelligent Investor. I've updated that. None of you that are already investing, the high dividend model was my first derivative out of that. There's a kind of an updated version of that, and I'm calling it the Bullington Capital Value Model. And I'm going to give a real deep dive look into that, how it works, why I think it belongs in everybody's portfolio. I've already invested in it. A couple of my clients have invested in it. We've added it to the other strategies. It hasn't replaced anything. We've taken some money from the other strategies and we put money in there. And at this point, at this stage in my career, and at this stage in the development of the stock market itself, I think it makes perfect sense. I think it's probably one of the best strategies out there. It's not as aggressive as the dividend model is. The dividend model is done very well, extremely well. But it's not as aggressive as that. It's actually considerably more conservative. And that was kind of the one of the reasons I was pushing to develop these models. I kept getting pushed by making my dividend model more conservative. And when I did that, and you might find this interesting, Jeff, when I added the attribute to that model that the company had to earn at least the amount of money that they were paying out as a dividend. That makes a lot of sense, right?
Absolutely.
If you're not earning enough to pay your dividend, you probably shouldn't pay that dividend. That wouldn't be the conservative thing to do.
Yeah, accountants would not like that.
But when you did that, it would reduce the returns on the model substantially. So you pay a fairly high premium for that reduction in the risk that you're taking by making it a requirement that the company has actually earned the dividend. And the reasons why, tend to scare people until they look at the performance. And by the way, to offset the fact that we're buying stocks sometimes who are not even earning the amount that they're paying in a dividend, I had to hold a lot of stocks, diversify it by not putting so much money into one of those stocks, because this is typically what would happen. Company would not be earning a dividend. Share price is already dropping like a rock because the institutional investors who dominate financial markets today, they know, they're looking behind the scenes and saying, hey, those guys are paying a dividend and they didn't even earn that much to pay the dividend. Let's sell the stock. Okay. Stock starts to go down a long time before the management finally says, okay, we're giving up the ship here. We're going to cut the dividend. They wait oftentimes a long time to do that. Now, occasionally, the company won't cut the dividend. Business will improve, and they are earning more than they're paying out in a dividend again. So that's a gamble on the management as to the future of their business. Do we think we can right the ship before we actually have to cut this dividend? So there's a risk there that they're taking, and that's an aggressive move. And if you eliminate those companies from that model, the performance has a tendency to drop pretty significantly. And I can tell you why. Everybody's afraid when they're not earning the dividend. The fear is so large that the share price will actually drop down sometimes below the net current asset value of the company. That was actually Ben Graham's favorite investing method. He called them net nets. Buy stocks that are selling below their net. That's an estimation of their liquidation value. And his liquidation value estimate was extremely conservative. The only thing he looked at was cash. Nothing for real estate, nothing for depreciated assets on the book, nothing. Literally, he took all the debt out, subtracted from their cash. So that was a very concern. Now, you can't find stocks like that again today, by the way. They don't exist. Because now everybody has access to a Bloomberg terminal and can find those companies long before they get down to those levels. Interesting, though, in the year 2000, Apple sold below its net cash. It was a net. Apple was a net. Everybody thought Apple was going away. So bottom line is back to the original story. Company doesn't want to cut their dividend. They keep the dividend in place. If the business does go very badly and they have to, at some point in time, cut the dividend, oftentimes the same institutional investors that drove the share price down will actually start piling back in that stock because they look at that as a sign that management is addressing the problems and are taking the appropriate steps to fix the problem. And you get moves of 2, 3, 4, 500% out of companies like that. And if you're interested, I'll send you this booklet that shows you some of those stocks, the actual stocks. You'll see AIG was in there. And when they came out and emerged, actually before they emerged, when they got good news, the stock catapulted. The dividend had already been cut, by the way. And the stock was kicked out of the portfolio because it had gone up so much that even the trailing dividend for a dividend didn't even exist anymore because it was eliminated. But the trailing yield would have been so low that it would have not made the cut to get back in on the next rebalancing, which is something that somebody trying to think about this is going to miss every time. Maybe not every time, but most times. So bottom line is, companies do things, they get in trouble. The share price tends to go down a lot. The dividend yield, even if it's a trailing dividend, even if it's a dividend that they've already cut, because you're looking backwards, you're looking at the dividend that has been paid in the past, and that's what you're making your decision on. Those companies, when there's the least little bit of good news coming in, it looks like they're going to survive. So now it's no longer they're going to file for bankruptcy. They're going to survive. Those companies' share prices will catapult. And that's why that strategy, by the way, is more aggressive, and that's why it's made more money in the past 10 years. You go back further than 10 years. So you give it a really, really long time period. And the more conservative models are much closer to the more aggressive models. But again, over the past 5 and 10 years, you've gotten smoked by being more conservative. And the model that I have that I'm going to be presenting is more conservative. We're not looking at the dividend. We're actually looking at the amount of cash the company is generating, a rough estimate, basically the operating income. Operating income, for those of you that aren't accountants, are what you have before you pay your taxes and any interest on any debt. Okay, it's just basically, did you cover your costs of running the business? Did you cover your costs? And if you covered your costs, how much did you cover them by? What do you have left over before you start paying interest and taxes on that money? And so it's just a rough estimate of how much cash the business is generating. If you're not generating any cash, you're not getting in the model. So a lot of the stocks that would make the dividend model, because they are having operating losses, but they're still paying a dividend, they would make it into the dividend model, and they will not make it into the more conservative model. The more conservative model is going to make sure that they are generating cash, and then it's going to look at the price of the entire enterprise, not just the share price. That's the other thing that makes the dividend model more aggressive. So to make a long story short and to stop boring people, there are two value models now. The dividend model is actually the more aggressive, and I've got a much more conservative value-oriented model that we're going to be talking about at the seminar. And it goes right along the lines of what Ben Graham had, the main thesis of what he was talking about, trying to minimize risk and still be investing in stocks. And I really like what he had to say about the stock market itself. He labeled the stock market Mr. Market. Mr. Market was manic depressive. Mr. Market would sometimes be willing to pay exceedingly high prices for your shares because they're exuberant and their mood was really good. The perception about the future was really good. And then other times it was extremely pessimistic and only willing to pay very minimal prices. So and to take advantage of that, you have to kind of get an estimate of what companies should normally be worth and then try to buy them when they're selling below those levels. And an easy way to do that is looking at, okay, what's the entire business cost and how much cash is it generating? So that's what the new model is going to be all about. And it's got a great long-term track record. It makes a lot of common sense. I'm absolutely sure that if Ben Graham were around today, that he would look at this and go, yes, that makes sense. And I think that's a good idea. I know he would, because I used a lot of the precepts in his book, or the concepts in his book, to create that model. So it just would be enormously labor intense to do those calculations on the 1,500 biggest stocks in the in the stock market every 6 months. So anyway, we're going to show you how we can do that. And you can go to my website, bullingtoncapital.com, sign up online. The seminar is free. It's March 16th. That's a Thursday. It's going to be 7 o'clock, Corporate College East. We're going to also talk about the website. Look out for the Bull, still under construction, very close to being done. And so we'll be talking about that for about 15 or 20 minutes at that workshop. And I think this is going to be I think it'll be a pretty good one. If you want to get out there, just feel free to sign up online. And let's see. Now we got to get to some of the things that I brought Jeff in here for. We've got a few minutes right before our first commercial break. And if you'd like to call and ask questions, Jeff can answer a lot of the questions you have on personal income taxes. But Apple Growth really kind of specializes in manufacturing, I think. Isn't that what you do?
Yeah, we work with corporate clients, privately held businesses, the owners, tax planning, and we have a very strong base of manufacturing, distribution clients that produce stuff and design products.
And you have a financial services firm that you do business for. I think they call Bullington Capital.
Yeah.
But yeah, so that's awesome. You and I've been in constant contact the past week or so talking about some of the changes that are being proposed by the Trump administration. So I think I'll just let you give the highlights on the things that we had talked about, if you want to kind of explain that to the audience.
Yeah, sure. Thanks, Bill. Basically, kind of tying it into the stock market, I mean, nominal highs here with Dow over 20,000. There's the perception out there that the business environment is very strong, and we think a lot of that is from the potential tax reform, regulation rollbacks that are out there, and basically what's being proposed right now is bringing the corporate tax rates down to, Trump had initially proposed a 15% rate. House GOP with Kevin Brady and Paul Ryan were looking at a 20%. It looks like a 20% level is where they might end up getting to. Also talking about bringing personal rates down as well, which helps small business owners from 39.6% down to a 33% level. And then the big one that's in there is potentially having business flow-through income actually be taxed at that same 20% rate. And Donald Trump structures all his businesses as flow-through entities, so he's one president who's in there who really understands how flow-through entities taxation works, and he's set on.
Let's stop for a second about that too. Flow-through entity. I know and the average listener probably doesn't understand that. Small business owner probably does, but a flow-through, like my corporation's a flow-through. We're actually a limited liability company. So what happens is when I take all my expenses out, everything I'm paying for, whatever's left over is going right to me as if it were my personal income. And so he's talking about reducing that tax to what level again?
To match that same 20% level that corporations pay. So yeah, when we talk about corporations, typically talking about C corporations, and that tax rate, has actually been lower than the highest personal rate. Highest personal rate right now, as I mentioned, 39.6%. Highest corporate rate is 35%. So they're trying to level those out to make sure that businesses that are more often structured as flow-through entities, as Bill described, are getting that same tax benefit that potential large corporations would in this tax reform.
Yeah, so I was doing my just a gruff estimate, and that would reduce my taxes pretty substantially, I think. Yeah, I don't know. You would actually know more about that than I would.
No, absolutely, yeah. So, and I think the market perception is that is correct. So, if you look at the S&P, 500 versus the Russell 500 since the election, or Russell 2000, Russell 2000 is actually up substantially. So, the smaller businesses are actually going to get a better.
Okay, we'll focus on that when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. We'll be right back.
And still there never seems to be a single penny left.
This is a story about Billy Joe and Bobby.
I just was thinking about that song. Isn't aren't part of the words "go on, take the money and run"? I'm not sure we should have that on the radio for just kidding. But anyway, here with Jeff Brooks. He's one of the accountants that works with Apple Growth. They're a Midwestern firm right here. Do a really good job. Work with a lot of manufacturers, financial services. I'm sure you guys have probably a lot of professional C Corps too. And I would think, but I don't know.
Yeah, we have a number of different kinds of businesses structured in all types of ways. More and more, as we talked about, our flow-through entities. That's the kind of ideal structure for that privately held business.
Yeah, so what he's talking about is in the old days, when I first started in the business, you were typically an S corporation or a C corporation, or you were a sole proprietor. One of the three. Those were the three most common. Today, you might be an LLC, professional, C Corp. There's a bunch of different, there are a lot more than there were when I first started in this industry, in some nuances. And we were talking about how the tax code has changed to kind of benefit a lot of those smaller businesses, the flow-through entities. So if you've got a business, you're an LLC, you're a S corporation. How does this really going to have an impact on those guys relative to the way the tax code's been set up in the past?
Yeah, so the key there is that, rates coming down is the key thing. They're going to, offset that by taking away some credits and deductions that are out there. But some smaller businesses aren't able to take advantage of some of those deductions and credits. So when they see a rate reduction, it's really going to be able to allow them to have more money to, reinvest in their business. Shareholder be able to put money out to shareholders through returns. So making sure that the tax rates come down both at the corporate and individual level, and then looking at the fact that understanding that flow through entities, that business income actually shows up on their 1040. That's something that this administration understands, again, better than past administrations in our mind. And then, as we were talking about just before the break, we really think that businesses based here in the United States are actually going to see the biggest benefit from this potential tax reform. We can go into some of the timeline and the details a little bit later in the show, but just to go back to that point that you were bringing up a little bit earlier, Bill. Big companies, C corporations, maybe like your Apples out there, they're able to take money and invest overseas. They're able to put their IP in different jurisdictions, Ireland or some other countries that have much lower tax rates. So they're not necessarily paying that highest effective rate for C Corps of 35%. So their benefit from this tax reform is going to be less than your smaller companies based here in Northeast Ohio, even your public companies that are based here in the United States, say a Dave & Buster's or something like that, where all their activity is here in the United States and they don't have a lot of deductions or tax breaks that they can take advantage of. So that lower rate is really going to help them on the margin a lot more, in our opinion.
Yeah, it's interesting that you say that, and you also pointed out that how much better small caps were doing. As an example, a small cap value index, IWN is its symbol, since the election is up 20%. The S&P 500, on the other hand, is up 9.3 over the same time period. So exactly what you just said, the smaller companies are benefiting more is what's happening here, because the bigger companies, as you pointed out, had the ability to shelter a lot of that income by having foreign headquarters or a big chunk of their businesses headquartered in a different area of the world, rather, that had lower tax rates. So now playing field's a little bit more even, but right. Not just for, and this is what I find really fascinating. So I get it. Those guys benefit quicker and more than the bigger companies are, because the bigger companies were already getting those lower tax rates by keeping their assets spread out around the globe.
Right.
However, I'm pretty sure that a lot of those companies would like to bring back a lot of the manufacturing. GE, in fact, is doing a lot of manufacturing again back in Kentucky, because it was really expensive to try to send a refrigerator back to China to have it worked on when it was under warranty. Actually, they didn't do that. Yeah, but there were a lot of problems that they ran into having stuff manufactured overseas that now they could manufacture in the United States. But it wasn't because of the unions. It wasn't because of the tax structure. It was actually because of technology. They could build the refrigerators with robots. It was a lot less expensive to build them with robots here than it was to build them with people over in China. And so technology was actually winning there. It was so much less expensive to build them with robots here, because now you just ship across the United States using trucking. You didn't have to worry about putting them on container ships, taking off the container ship, all the taxes you have to pay going in and out of various countries and whatnot. And you're talking with Americans. There's no language barrier, so it was actually a lot less expensive to build here. Now, they called it Appliance Park in Kentucky. It had so many people working there that they had their own zip code at one point in time. There were 20,000 employees in that one little town in Kentucky. So I don't know if I'll have to check to see what it's doing lately, but it's getting up to 4,000 to 5,000 people after being down from, maybe 1,000, like a skeleton crew running around there. So to bring a lot of those jobs back, But now, when they bring the jobs back, now they instead of having to worry about playing a bunch of games with taxes, if that's going to help that one division of GE out a little bit, not a lot, because all it'll really do is reduce some of the paperwork and some of the headache that they have, which is still a big deal. But I get it when you say the smaller companies getting the benefit. Now they're benefiting the same way that the larger companies could benefit before, where they couldn't because they couldn't afford or didn't have it in their budgets to go and move a lot of their manufacturing offshore. And so I think that's a big deal, and something that, quite frankly, I didn't think of until you brought it up. I was like, oh, hey, small caps are moving again. Actually, they're moving really fast, and I can tell you the stocks come up on my screens. They're almost all small cap. The most all of them have most of their revenue in America, and I really that hadn't dawned on me. I saw it coming up in the screens. I didn't know why, and then when you said that, I was going, oh, that makes perfect sense. So that's kind of cool. And that's not just for the publicly traded companies, and that's kind of reason I wanted to have you on this weekend. This is for anybody,
right?
And there's some things that if you're a business owner, you might want to do. We had talked about taking some of the depreciation as quickly as possible.
Yeah, so there's absolutely stuff you can do right now, and companies are out there doing it. We're working with our clients on it. So 2016, the tax law is set. That's not going to be changing. But, tax returns aren't going to be filed until March 15th. You can extend them longer than that. And there's things you can do before you would file your 2016 tax return to lower that tax bill. And this year it's really important because what we're hearing out there is that they're going to move very quickly on tax reform, and very likely could be retroactive to January 1st of 2017. So tax rates for all of 2017 could be, as we talked about, much lower than 2016. So what we want to do is pull all deductions that we possibly can into 2016. So, and some of those deductions, as I mentioned, might not be there in 2017 because of tax reform. If they're lowering the rates, they're going to take away some of these deductions. So manufacturing companies really want to make sure they're maximizing their domestic activities, production, deduction. That's kind of a mouthful, but there's a deduction out there for manufacturers that is there for 2016. Absolutely want to maximize that, and you can do that calculation after the year wraps up. Other big thing is accelerated depreciation. Anything you bought during 2016, want to make sure you're making the elections to take that maximize expensing for those pieces of equipment. And then the other thing that people don't think about is if you're buying real estate, if you're buying a building, and if you've really done it in the last couple of years, what you can do is you can go in and break that building out. It's what's called a cost segregation study, but you pull out some parts of that building, and you can actually accelerate that depreciation, and you can do it all at once. So in 2016, you could catch up some of that accelerated depreciation you missed out in prior years. So if we can get $1 million of deduction in this year versus taking that $1 million out in the future, that really is a huge benefit if you're going to offset tax rates in the 35% range versus the 20% range on $1 million. That's right there, $150,000 of real savings, along with obviously the time value of money.
And there's also you talked something about, and incidentally, if you hear what you like, or like what you hear rather, if you like what you hear and you want to contact these guys, their website is applegrowth.com. That's applegrowth.com. You're speaking to Jeff Brooks. He is a CPA that works there and does a lot of other stuff too. But anyway, you can go to applegrowth.com. You can also contact me on my website, Bullington Capital. I can forward you his contact information. But one of the other things that we had talked about was actually going back and refiling tax. You may be able to get money in the past. And maybe you could elaborate a little bit on that.
Yeah, so what we were talking about there is with the deductions that you're able to take in 2016, you can actually take deductions in excess of your income. If you went out and bought a multi-million-dollar facility, you had some profit, but were able to take a bunch of accelerated depreciation actually show a loss based on that depreciation. It's called a net operating loss. That actually got a lot of play during the election coverage. I know, so people probably
because Trump's been doing that,
right,
or trying.
So that's been. But you can take that net operating loss and actually carry it back into prior years, get a cash refund of tax paid at those higher rates. Because think about it, the last couple of years we've had the higher rates. So if you can take those deductions, go back, get cash back in the pocket, and then use that to reinvest. That's kind of a great opportunity for business owners. Companies out there are doing it, and as a business owner or somebody who's investing, just being aware of that and making sure you're taking advantage of is something you need to be doing.
Absolutely. And again, if you want to contact, you're driving, I get it. You're listening to this. If you're listening to this on iTunes, that's great. Go to Apple Growth Partners, or applegrowth.com is their website. Again, this is Jeff Brooks. He's here this morning in the studio. If you have questions, feel free to call us, 216-901-0945. And I forgot to give that out earlier today. Sorry about that. But 216-901-0945, you can call in and ask a guy questions that would typically cost you some money to ask if you're on the clients, and he'll answer them for free. You can also email us at bill@bullingtoncapital.com. I'd be glad to forward their contact information to you anytime you'd like. Again, I wanted to just thank you for coming in today, because this is a big deal. There are a lot of changes coming down. You're a small business owner. It could have a big impact on your bottom line. It's definitely going to have a big impact going forward.
Absolutely.
There's no doubt about that. But anyway, again, the phone number here, 216-901-0945. We got a couple minutes before commercial break. Anything else that you wanted to add to that?
Well, just the timeline a little bit. So just, people are hearing a lot of activity going on out there. We stay in touch with, what's going on from the leadership in Washington. We also have contacts there, some top attorneys that are in D.C. and follow this process, and everything seems to be lining up in this fashion. So timeline as far as it's related to tax reform, the Affordable Care Act, addressing that with a repeal and replacement, is first in line, looking like there might be something that gets done with that in the first 200 days. And that does affect your tax bill as well, because remember, there was the 3.8% Affordable Care Act surcharge on investment income, so that's gonna go away. At least that's what our understanding is. So that gets done first. The next thing on the list is full tax reform, as we've been talking about, with the reduced rates, eliminating some deductions. That gets done, what we're hearing, before the August recess of 2017, and highly likely it's retroactive to the beginning of 2016 as far as what the rates are. Again, this is going to go through, obviously August is still a ways away, but as far as government, that's pretty quick to act. So just wanted to lay that out there.
Okay, that sounds good. Hey, you're listening to Bill Bullington and Jeff Brooks from Apple Growth right here in Akron, Cleveland, Ohio. Stay tuned. We'll be right back after these commercial messages.
If I could.
And we're back. Hey, you've been listening to Bill Bullington. I'm here every Saturday morning from 11 to noon, right here on 1420 The Answer. I've had with me Jeff Brooks from Apple Growth Partners. He's an accountant, and this is the accounting firm my firm uses. A lot of good things coming out today. Thanks again for coming in, Jeff. Appreciate it.
Yeah, glad to be here.
And if you want to contact them, you can contact me through my website, or just go to their website, applegrowth.com. And we'll try to get these guys on again in the future, because there's a lot of change coming down. And I got to tell you, small business owners are getting real help. I'm amazed. I'm absolutely amazed. I'm flabbergasted. You do need to ask for the help, though. This stuff is pretty complicated, and I don't even try to do tax consulting anymore at all. I won't do that. it's a you really need a professional for that. So Apple Growth is highly recommended. You own a business, especially if you own a business, you should probably talk to them. If you'd like to call in today, by the way, 216-901-0945 is the number here in the station. And I believe I got Brian. Hey, Brian, how you doing?
Oh, hey, Bill. How's it going?
Good.
I was just wondering, any interesting stocks show up on the momentum scans this past week?
Yeah, actually, and I'm glad you asked because we're going to come to that anyway.
Okay.
Yeah, so I've narrowed down the list to just those companies that have the highest probabilities of moving up quickly. And, of course, you know that that's going to come out on the Look Out for the Bull website, which is under construction. It's almost there. We applied to the state of Ohio. When you're a new LLC, you got to form the company, and there's a lot of paperwork involved with that. I was going to do it as a sole proprietorship, and I thought, I better not do that. So anyway, I held it up. But as soon as we get our EIN number and all that stuff back, then we're going to be ready to go. And I got to tell you, this is a good time to be doing this. This is a really good time to be doing this. We talked a little bit earlier on the show about how the smaller companies are up. The small cap value index is up 20% since Trump got in office. The momentum portion of the model that I run's up about 22. It's not all the money in that fund, by the way, but it's about a third, and which is that's pretty good. And I can tell you that they're all small mid cap stocks. I haven't seen a lot of large companies in quite a while, and I'm really excited about it. One of the companies I've been stopped out of a couple of times, actually, in the past 4 or 5 months. It's marginally profitable, but which is kind of interesting when you've got 5 trades and 4 of them are losers, and you're still making a little bit of money. That's because you've been doing this a long time. Most people have 4 out of 5 losing trades. They're behind the 8 ball big time. But that's something that we'll go into on the website and talk about it. But anyway, to go to a company that could challenge that record, by the way, my record, by the way, is getting stopped out. I think it was 4 times in a row on Overstock.com, and I took 4 10% losses in a row, and it comes back up on the scan a 5th time. And I was just a big fan of the business. So I bought it again thinking, here I go. I'm going to give another 10% up on this one. And end up going up 75% before I got stopped out. So I got all my money back and then some. Anytime I say that, someone goes, well, why didn't you just hang on to it? Well, because you don't know that it's going to stop going down and go back up again. That's why you have to do that. Anyway, this company is reminding me of that. It's Freeport-McMoRan, FCX rather.
The copper company.
Yeah. Yep. So this has been a nemesis for me. It's been really volatile. Most of the metal stocks, I had some profits in recently. U.S. Steel, AKS. There were a couple others that I've owned they were profitable and then stopped me out. And I think I just got stopped out on a couple of them with small losses. But anyway, I like Freeport-McMoRan. It's just one of the companies that came up. So I have to disclose when I own this stuff to people because I am running it in a fund, and that's something that I will do on a website. If I like something, I have to tell you before I buy it when I'm buying it, and I'm telling you where my stops are ahead of time. So because I can't tell you I'm going to sell it before I sell it, because I'll have a stop in there, it'll automatically stop me out. But that is disclosed. That will be disclosed on the website. But Freeport-McMoRan came up. There's a lot of companies that will come up on these lists, incidentally, that won't come up on other lists because of the way I've rewritten the scans. So it's,
okay.
Yep. It's no longer.
Well, hey, I look forward to the new Look Out for the Bull website. It's going to be great.
Yeah, it should be fun for those of you that like doing that sort of thing. By the way, Wynn Resorts came up. And, that stock is really volatile, and that scares an awful lot of people. Some people that, the stock came public a few years ago. And are you familiar with Wynn Resorts out in Las Vegas?
Yeah, a little bit.
Yeah. Well, anyway, the guy's he's a character. There's no doubt about it. Comes public around $122. Goes up first few months, gets up to about 150, turns around, crashes. 2012, it's down to $88. Goes from 88, gets all the way up to 222. More recently, at the beginning of 2006, it was as low as 50. But you know why it does that, Brian?
Because it's stock.
That's right. Because it's a stock. So anyway, if you look at the chart on it now, it's been in a base since last April. So if you're out there driving around and you wonder what a base is, here's a classic textbook picture of what a base looks like. Look at what that stock has done since April of last year. It's gone sideways the entire time. It's a fairly restrictive range. And that's what a base looks like. Okay, so yesterday, the stock has 8 million shares traded in a single day. The average is 3 million. Okay, so it's trading 8 million shares. It actually gapped up. So the stock gapped up. It closed the day before. Actually, I have to look this up. The closed at 95.50 the day before, and then yesterday it closed at 103. So,
Wow.
Yeah. So it gaps up on more than twice its average daily volume. Closes in the upper half of that day's range, which is also important. And it's within 5 or 10% of its 52-week high, which is also kind of important. When it hits that 52-week high list, there are still a lot of traders out there who only look at new 52-week highs. So it might get some support from them when they come in and start buying. And if it doesn't, since I've only got 5% of my money in it and I have a 10% initial stop loss, I'm only risking 0.5% anyway.
Yeah, that's true. Hey, Bill.
It doesn't really matter.
I have something I want to say hi to you real quick. Hold on one sec.
Okay.
Bill?
Hey.
Hey, it's Maureen Wells. How are you?
Oh, hey. How you doing?
Good. Brian's down visiting. I'm sorry, I have a bit of laryngitis. Brian and his sister are down in Florida visiting, and he said he wanted to call the show, so I just thought I would say hi too.
Oh, well, hey, that's awesome. I'll have to get his number from you and catch up.
Yeah, please do. Please do. I would love to catch up with you too.
Yeah, that sounds good. Well, hey, have a good rest of the weekend.
Oh, you too, Bill.
Thank you.
Good to talk to you.
Yeah, yep.
All right.
Thanks for calling. All right.
Bye-bye.
Yep. Bye-bye. And I'm going to go right now to Jerry. Jerry, hey, you have a call for us or a question for us?
Yes, good morning, Bill.
Hi.
I wanted to see what you thought about a company called Splunk, symbol SPLK.
Okay.
Familiar with that one or not?
I can look at the chart. I actually don't have time to pull up their financial statement. And the chart looks okay. This stock actually gapped up a few days ago and then has since pulled back on really low volume, which is kind of a good sign. It looks like it's a software company. So what can you tell me about it?
Well, I know they're in the data analytics space, and I know they've never turned a profit.
Okay, as an investor, that would be a big turnoff. But unless they have an operating profit, and depending on what the market cap of the company is, I would actually have to look that up. If you want, I can look it up, and then I'll remember to talk about it next week if you'd like.
That'd be great.
Okay.
That'd be great because, it's a company that has a lot of customers, both in the United States and worldwide, and the software that they market is very unique. It's like nothing else out there in terms of its capabilities. And I just can't understand why they're not making money at this point in time.
Yeah, a lot of times they are spending money. They may be actually generating cash, but reinvesting that in a lot of the things that Jeff and I were talking about that you're allowed to depreciate really quickly. And with technology, you get advanced accelerated depreciation on a lot of that stuff. So it may look like they're not making money, but they could, in fact, be making some money. So I'll take a look at it and cover it again next week.
Great, Bill. Thanks.
Yep. Thanks for calling. You've been listening to Bill Bullington here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.